Good morning, investor and Thai Oil Public Company Limited. The Stock Exchange of Thailand welcome you all to the SET Digital Roadshow Year-End Performance of 2020. The session will run about 45 minutes, including Q&A. Presenting company will start the session by 30 minutes presentation, followed by the 15 minutes Q&A. During Q&A, investor may leave your questions in the meeting room chat box or use raise hand function. Then presenting company will open your microphone so you can ask the question to the company directly. May I now invite Thai Oil Public Company Limited to start the presentation, please.
Okay. Good morning, investor and analyst. My name is Thosang Chaipravat. I'm the Vice President of Financial Planning. On my right is Kun Nattapon Noprarat-Wong. He's a Manager of Investor Relations. And on my left is Kun Chiriyon Liengrunlom. She's an Assistant Manager of the Investor Relations. For today's agenda, okay, there are 4 agendas today. I will be covering the first agenda on the fiscal year 2020 key highlights. Financial performance analysis will be covered by Kun Chiriyon, and 2021 outlook will be covered by Kun Nattapon. Let's start on the first page. Year 2020 was an extraordinary year with several factors affecting Thai oil performance. COVID-19 pandemic has caused a lockdown in many countries around the world, leading to a significant drop in oil demand by almost 20% in the second quarter last year. While the global oil demand began to recover in the second half after the easing lockdown, jet fuel remains under pressure by limited international flights. In addition, we have the oil price war and OPEC deal failure in March last year. Together with COVID-19 has brought down oil prices to multi-year low. By the fourth quarter of last year, successful development of vaccine has lifted sentiments and improved oil demand and oil prices. Last year, refining sector was the hardest hit. As for Thai oil, we have huge stock loss in the first quarter, with a significant drop in the petroleum oil demand, especially the jet fuel, and we have worst ever GRM. In response to the situation, Thai Oil has implemented 3 key strategies, namely people first, short-term profitability improvement, and long-term strategic execution, which I will go into the details on the next pages. For people, our people safety is our first priority. We have established iCovid Center and implemented preventive and protective measures, including work from home, workforce segregation, and BCM. So far, we have 0 staff infection. For Thai Oil, safe workforce is critical to ensure smooth operation, safety, and reliability. As for the short-term profitability improvement, for operation, we have optimized the overall value chain utilization and production. As you can see, the refinery run rate is still at a high level of 101%, a bit lower than year 2019 due to a lower oil demand. However, you can see the utilization rate of other businesses still remain at the good level. We also have stretched our operational boundaries by lower the jet production from 23% to around 10% for last year. And also we have carried on a successful Labix major turnaround in the third quarter of last year. Commercially, we have optimized the crude and feedstock procurement. For example, we have increased our Middle East crude purchase when the OSP was low. At the same time, we maximize the domestic and Indochina sales and also increase our high volume product sales. Financially, we have implemented the cost reduction program, which we cut more than 20% of our operating costs last year and postponed the CapEx spending from 2020 to 2021 by almost $800 million. In addition, we have secured competitive pre-funding, including the $1 billion US bond and also the 15 billion baht long-term bank facility to ensure adequate liquidity. As for our long-term strategic execution, we continue our long-term strategy. For CFP, although the COVID-19 has constrained the CFP progress in terms of the workforce mobility and the lockdown in major EPC countries, we have managed to achieve 60% progress at the end of December last year, and we plan to catch up the construction as much as possible to achieve our COD by 2023. We also have rationalized our existing business, namely power and marine. We streamlined the holding of our power assets, and we have divested our Thai Oil Marine to the company called Prima Marine. For the Thai Oil Marine divestment, we expect to complete the transaction by the middle of this year. We also continue to pursue our new strategic growth path through study of olefins and also investment in startups. In summary, last year was a very special year, a challenging year, but we pulled through with extraordinary achievements. We have the biggest net profit comeback, 10,000 million baht from a net loss of 13,000 million baht in the first quarter through operational flexibility and extra commercial efforts to maximize our margin. We also implemented stringent cost reduction, and we also secure competitive pre-funding. Last but not least, we also executed our power and marine business restructure. And to end the first part, I'd like to draw your attention to our ESG and sustainability highlights for 2020. For environment, we have achieved our target for the GHG reduction, circular economy, and energy efficiency. For social, our key theme is sustainable energy for healthcare, which we provide renewable power to hospitals in Thailand. And for governance, we achieve zero non-compliance. In terms of the reward and recognition, once again, we are DJSI Oil and Gas Industry Leader for the 6th year, and we are the member for the 8th executive year. So next, Khun Chuliyon will cover on the financial performance analysis of Thai Oil.
Thank you, and let's move on to the key performance for the fourth quarter and full year 2020. I will recap on the key figures, key financial figures for the main business unit, and also cover on the investment plan and including the funding plan. And I will start with refinery business in terms of utilization on the top left chart. In Q4, we had run rate 101% for refinery is higher Q on Q, following oil market recovery from COVID-19. And if you see in the line, you will see that our run rate was also higher than the industry run rate, 86%. And in 2020, we ran 101% as well. It was higher than the industry run rate at 87%, but it was lower compared to the previous year in 2019. We ran 107% due to the collapse in the domestic oil demand from the COVID-19 pandemic. And speaking of the oil demand, on the top right chart, you will see that last year the oil demand in Thailand was dropped by 11%. And from the bar chart, you will see that the jet fuel demand significantly dropped by 62% year on year due to the off-flight cancellation, while gasoline and gas oil was not much impact, only dropped by 1.5%. And in terms of commercial, if we break down by customer, about 50% of our total petroleum products we sell to PTT through PTT OR, followed by other domestic customer, including PTT and Sasco, and also the major oil like Shell, Chevron, and Bangja. And the remaining we export was the export sale. And looking at the local and export sale on the right, on the bottom right, we still maintain high portion in local market, more than 87%. And for export sale, we maximize the CLMV market like Cambodia, Laos, Myanmar, and Vietnam, about 10%. and for the export to other countries like Singapore and Hong Kong, only 3%. And if you look at the figures compared to the industry, you will see that Thai Oil, we can capture higher sales portion than the industry, both in local and CIB market. And move on to the refinery margin. In Q4, we report the market GRM at $1.2 per barrel. It's improved Q1Q due to the lower crude cost and also improving product margin, especially jet and fuel oil. And for the full year refining margin, as Ms. Thorsang mentioned earlier, that we had the lowest GRM, only 40 cents per barrel last year. And that's because of the impact of COVID-19 pandemic that causing the significant drop in the oil demand. And if you see in the table, you will see that the oil products spread drop a lot, especially jet fuel from $13 per barrel dropped to only $2.5 per barrel last year. But so far in Q1, we are seeing an improvement in oil demand, and we expect that our GRM this year could improve from the bottom 40 cents last year. And for the detail, I think Mr. Natapon will walk you through later. And in terms of the crude price, last year we booked stop loss $2.3 per barrel, or around 7 billion baht. That's because of the key event like oil price war and the COVID-19 pandemic, as Ms. Thorsang mentioned earlier. And so if we combine the market GRM with the stop loss, so last year we had a negative accounting GRM minus $1.9 per barrel. And move on to the aromatic business. In terms of aromatics contribution in Q4, the contribution from aromatics and LIB was $1.6 per barrel, mainly from improving benzene demand for packaging. And in 2020, the contribution from aromatics was $1.5 per barrel. It's higher year-on-year from 1.1 in 2019, consisting of $1 from aromatics and 50 cents from LAB business. And in terms of the aromatics production, we run at similar level, averaging around 70 and 21%. And next business unit, the lube business. In Q4, the contribution from lube and bitumen was 80 cents per barrel, is stable Q1Q. And for the full year 2020, the contribution was 50 cents per barrel. It's slightly lower than 2019. But so far, the lube spread is extremely strong, supported by the supply side from the supply tightness because many refinery cut their run. So it's a lower feedstock to lube plant, and also the unplanned shutdown in the lube plant as well. So we could see an improvement in the GIM contribution from lube business in Q1 and in first half probably. And in terms of lube production, last year our lube plant ran at normal level at 88%. And if you combine all margins from refinery, aromatics, and lube together, we show the integrated margin on the bottom left chart. In the fourth quarter, we had GIM expo stock $3.6 per barrel, or $5.8 per barrel, including stock loss, including stock gain. And in 2020, we had $2.4 per barrel is GRM exclude stock loss, or 10 cents per barrel, including the stock loss. And that's for the margin side. And move on to the right side in terms of cash cost. The top right chart shows refinery cash cost. And I would say that our refinery operating cost still competitive compared to others, which was only $1.5 per barrel for last year, and also 90 cents on the interest expense. And in terms of the group cash cost on the bottom right chart, the group cash cost increased by 50 cents from 1.5 refinery operating cost to $2 per barrel for the group operating cost, and plus 90 cents for interest. So the group cash cost in total was $3 per barrel. And let's move on to next business unit. I would say that the power business unit can continuously generate growing contribution to our group. And in the fourth quarter, we had contribution from power business in total 510 million baht, mainly from equity income from GPSC. And for the full year 2020, our group had a contribution from the power business 2.6 billion baht, consisting of the contribution from our own power plant, Thai Oil Power and Top SPP, around 860 million baht, and also the equity income from GPSC around 1.8 billion baht. And this portion obviously higher compared to 2019 because GPSC completely acquired the stake in Glow. And go to next slide. Okay, this slide shows the performance breakdown by business unit. And for the main business unit, refinery, aromatics, lube, and power. In terms of the key figure, I've already mentioned, but we also have the contribution from other business, kind of supportive business, such as solvent business, marine, and ethanol business. For 2020, we had a contribution from this business around 700 million baht, accounting for 13% for the net profit of the net profit contribution. And let's move on to the financial position on page 25. In terms of the financial position, in 2020, we aimed the cash, with the cash on hand $2.3 billion, while we have debt in terms of the interest-bearing debt $4.8 billion. So if we net the cash and the debt, so we in a position last year with debt about $2.4 billion. And speaking of debt, in terms of the cost of debt, it was 4.1% per annum. And netting with the interest income, the cost of debt reduced to 3.6% per annum. And in terms of the key financial ratio, you will see that last year's numbers was obviously higher compared to the previous years, especially net debt to adjusted EBITDA is increased to 12.4 times from 3.5 in 2019. Is because of the tough market condition as a result of COVID-19 pandemic. And for the net debt to equity was 0.6 times, higher from 0.3 in 2019. Actually, I would say that we don't have any debt covenant, but we try to keep the ratio to not exceed 1 time according to our internal policy. And in terms of the credit rating, S&P recently one notch downgrade our final rating to BBB from BBB plus, following the downgrade of our parent PTT. And they also revised the outlook to stable from a negative outlook as to mirror the PTT rating. And for the Moody's and Fitch rating, still maintain our rating at Baa2 and AA minus. And next slide, please. Lastly, in terms of the CapEx plan, the investment plan from this year to 2024, our plan is about $2.2 billion, consisting of 1.9 billion for CFP and $200 million for ongoing projects and $145 million for our subsidiary expansion project. And as I did mention that we had cash on hand last year, $2.3 billion, but in the early of February this year, we already spent for our power restructuring. So we spent about $3 million. So far, our cash reduced to $2 billion. But If you see our spending, the plan was 2.2 billion, so we need to raise fund at least $200 to ensure our liquidity for the next 4 years. But from what we are seeing now, the oil market recovery, so we expect the cash inflow from the operation. And as Mr. Thorsan did mention earlier that about the pre-funding last year, we already secured the long-term bank facility approximately $500 million. And other than that, we also have other funding plans such as to raise by the debt, raising by debt by the perpetual bond that we expect to raise fund from this option up to $1 billion. And I think that's cover all for the financial part. I will hand over the session to Mr. Nathapol for the market outlook.
Okay, thank you. And the last section is 21 outlook. So I cover the crude oil price and the margin for the 3 sectors that we have, which are refineries, petchem, and also base oil. For the benefit of time, please feel free to send your question to the chat box, and I'll try to address during my presentation. So for the first part, let me go through our crude oil price outlook. So last year, Dubai price averaged around $50 per barrel for December. And during March so far, it's moved up to around $65 per barrel. And we expect oil price to move around $60 to $65 per barrel range for this year. So the main factors would be on both as demand and supply. On the demand side, the market particularly expect the vaccine rollout across many countries in the world. And we expect during the second half of this year, above 60% of the population of key economies would be vaccinated. And hopefully that will help to bring down the daily infection and improve the consumer confidence to travel more. So this year, we expect oil demand to bounce back by 5.4 million barrels per day after dropping almost 9 million in 2020. So combining 2 years, we still short about 3 million from 2019 level. So the main decline would be on the jet fuel, which we expect the demand for this product to come back in a year later. In terms of supply, we are seeing a very strong compliance and also a strong position from Saudi and also other OPEC Plus member after they recently extend the cuts to April. So coming into Q2, the market would continue to be supported and moving into the second half of the year as demand continue to recover. If you look at the balance during the second half, the market would be slightly short and will draw the inventory that we built quite heavily during the first half of 2020. And the crude oil inventory will be back to the normal level by the end of the year. And that's why we think that crude oil price should be quite supported during this range. And moving into the margins for refinery, as you know, that last year the refining margin has been under pressure. So the Singapore margin moving around $0 to $1 per barrel along the year, and average of 40 cents per barrel. And Thai oil margin also reported at the same level of 40 cents per barrel in 2020. And so far in Q1 2021, we are seeing improving product spreads, especially gasoline and some of the middle distillate. If you look at the quarter to date after gasoline, it's now around $7 per barrel, increased from $4 per barrel. And for the middle distillate, gas oil or diesel margin improved from almost $1 per barrel already from Q4. And the key would be the improving product demand in the region and also across the world for the remaining of the quarters of this year after the successful rollout of the vaccine. So if we look at the product demand on the next slide, so we lost a lot of demand during Q2 last year, about 15 million barrels per day, and the recovery has been quite sharp during Q3, but a bit slower during Q4 and Q1 because of the surging COVID cases in many countries. But moving into the second half of this year, we expect gasoline and diesel demand should continue to recover, and there's potential that it could be back to almost pre-COVID level by the end of the year. But the jet fuel is still lacking, so it will take at least like 2022 to be back to the pre-COVID level. In terms of the product inventory, similar to the crude oil inventory, it peaked during Q2 last year, and we're seeing continued draw in the product inventory since Q3 last year because of low refining utilization rate. And coming into 2021, we think that the inventory should be back to the normal level by the second half of this year, and especially during this period that we had the cold snap in the US. So if you look at the US inventory alone, gasoline and middle distillate inventory dropped quite significantly, combined about 50 to 60 million barrels per day during a month or so. So this helped to balance the market in coming months, especially during the summer season when gasoline demand normally peak during like May to September in the US. And on the supply side of the refineries, as the market has been under pressure since last year, so there's a news that many refineries announced to shut down their capacity permanently or convert to import terminals. So last year, the combined closure announced about 1.5 million barrels per day, and this year we expect there will be a further closure about 1 million barrels per day for our base case. So the combined closure for this year will be 2.5 million barrels per day. And this will help to balance the market when demand recovers during the second half of this year. So if we look at the product by product a little bit, so for gasoline, we expect this product to outperform our other slates because of improving demand. So if you look at this mobility index at this moment, it's coming back to almost the same level in some countries, especially in Asia. And if you look at the demand on the right-hand side, demand in Asia will be back to the pre-COVID level already in 2021. But some countries and some regions are still lacking. But by the end of the year, we think that gasoline demand should be back almost the pre-COVID level. For the next one is the jet fuel. So the main applications is the traveling. But during Q1, we also had some another demand surge from the heating, especially in Japan. So that helped to balance, to draw the inventory in the market a little bit, so that the jet or kerosene margins during Q1 increased Q on Q. But on the commercial flights on the right-hand side, we still lacking compared to the normal level. So it's now about 60 to 70,000 flights per day. So the normal level would be around 100 to 120,000. So it will take at least during the second half to see the clearer picture for the recovery. So based on the recent projection, by the end of the year, the jet demand will still be lower by almost 2 million barrels a day compared to 2019. On the diesel market, similarly to gasoline, we are seeing increasing demand, especially in Asia. So the logistic improvement in this region, and also the Chinese gas oil demand that's coming back to the pre-COVID level, help to support gas oil demand in this region. And coming into the second half of this year, gas oil demand in Asia will be back to pre-COVID level as well. But for some region like the European countries and also the US, there's still some lagging recovery in that part. And for the last product is the fuel oil. The fuel oil demand has been quite resilient. In 2019, we haven't seen much decline in Asian fuel oil demand from the COVID-19. And 2021, we expect demand for this product to grow by about 5%. So that's why the margin for fuel oil has been very stable at around like -$3, -$4 per barrel. In terms of supply, because of refinery run cuts, so we are having a significant drop in the global fuel oil supply in the market. And this concludes the margin for refinery. So on the supply side, we see that the closure help to support the recovery during the second half. So we expect the margin to continue to perform during the rest of the year. And in terms of the domestic demand, we rely on the demand in the country about 90%. So in Thailand, we are in a better shape because controlling the COVID case better than some countries. So last year we only lost gas oil and gasoline demand about 1.5%. And this year we expect gasoline and diesel will be back to increasing by about 1%. But on the jet fuel, because we rely on the international flights quite a lot, so still lower year on year, about 12%. And let me move on to the aromatics sector. So as you know that in 2019 and 2020, the market is still under the down cycle because of the capacity additions in the region. So the combined addition during 19 and 2020 will be about 14 million tons. And demand growth usually grow about 2 to 3 million tons a year. And last year, actually, we lost 3 million tons from the impact of COVID-19. But coming into 2021, demand will outpace capacity additions. And that's why we are seeing a slight improvement in the margin for PX and benzene. And especially during the first half of this year, we are having a lot of downstream startup for PX. So the combined PTA capacity startup in China during Q1 and Q2 will be around 8 million tons, which is equivalent to about 5.6 million tons of the PX. So we are seeing a surging demand for PX buying in the region right now. And also during Q1, we had some cold snap in the US, which is cutting supply of the PX and benzene in the global market quite a lot. So on the benzene side, on the right-hand side, the capacity addition during 19 and 2020 was a bit lower than PX, but still pressure the market. But coming into 2021, demand will be slightly more than supply. So similarly to GPX, the margin is expected to increase year on year. And the last section is on the base oil. So the base oil margin has been outperforming since Q4 last year, and the Q1 still very strong. The base oil margin over high sulfur fuel oil in Q1 now is about $700 to $800 per ton compared to $390 in 2020. So that improved our contribution from this sector quite a lot. And the main reason would be on the supply side, because refinery run cuts in the region, reducing supply of the feedstock to base oil plant. If you look at export volume from key exporter in this region, it's much lower than the normal level, while the demand is improving along with the gasoline and diesel demand for transportation. So that's why the market is quite tight at this moment. And for bitumen on the bottom right charts, we rely on bitumen sales in the country now 99%. And this year, there will be increasing road repairs and also budget for construction. So we are seeing increasing demand for bitumen from our side. And in terms of the margin for bitumen, it's still positive to the feedstock, which is the fuel oil, because of the low supply from refinery as well. So to conclude the outlook, we think that the oil price should be around 60 to 65. So we should have some inventory gain to be realized in Q1 this year. And for refining margin, it's still in the recovering path. So during the second half, we should expect better margins. And for aromatics, at this moment, during Q1, Q2, because of the increasing startup of the downstream, so we should see some improving contribution from this sector. And the last one, the base oil, as you see, there will be a significant increase in the base oil contribution because of the supply that I mentioned earlier. And this concludes the presentation from the company. Then let me open the session for Q&A.
Now we have 5 more minutes for Q&A. Should investor have any question, you can send through the chat box or use raise hand function. So I think if there are no questions, if there are no questions, I think the session has come to an end. the Stock Exchange of Thailand would like to thank you investors and presenting company for joining us. We look forward to welcome you all again in the next quarter ค่ะ Thank you very much ค่ะ
Thank you.
Thank you.
Bye.
ค่ะ